Anyone who's been looking at what's going on with financial markets in the UK will know that we've had two big interest rate cuts in a very short space of time. First off, we had the Bank of England cut the base rate from 0.75% down to 0.25%, and then within a week they've cut down to 0.1%. This is also tied up with the Bank of England announcing they will pump more liquidity into the system. They're bringing more money into the system to make sure that there is liquidity in the UK financial markets, and this is about trying to shore up business confidence in this difficult time and giving businesses enough room to trade through the worst of the coronavirus epidemic in the UK. So ultimately, this also is tied up with what's going on with the wider government announcements around support for businesses during this difficult time. So that's grants to some particular types of businesses severely hit by the impact of COVID-19, but also some business interruption loans, which will be available from mainstream lenders, but will be underwritten and supported by the government. So this is part of a whole range of measures with the government and the Bank of England working together to do everything they can to shore up the financial situation and the economic situation in the UK. So ultimately, what does an interest rate cut mean for those of us who are property investors? Well, if you're on a tracker rate, especially one that tracks a Bank of England base rate, you're probably in a very good position right now because the Bank of England base rate has dropped so significantly. Now, ultimately, that might give you a period of time where you have a significant reduction in your mortgage payments, which may help to offset some of the potential issues we might have with potentially tenants having difficulty paying over the short term because of situations with their employment, which will affect their ability to pay. But the majority of us probably aren't on tracker rates because most of us who are professional investors will gravitate towards fixed rates overall, or if we are on tracker rates, a lot of these tend to track LIBOR rather than the base rate directly. So at this stage, it's really the liquidity that is probably more likely to have an impact on the actual pay rate that we pay. And as long as there's liquidity still moving through the system, we should see interest rates remain at a fairly similar level or potentially drop a little bit. We know in the last few months we've seen a fairly large influx of liquidity into the property market overall in the UK, and lenders increasing competition with each other, fixed rates dropping, especially over the 3 to 5 year period from a number of lenders that we might access in the marketplace. And the Bank of England dropping the base rate will probably increase the ability of some lenders to drop some of their rates as well with some of their fixed rate products as well. But don't expect that suddenly we're going to see all of the mortgage rates drop by a huge amount. We've got to remember this at the moment is a big drop in the Bank of England base rate, not just directly affecting the property market, but to make lending and borrowing and liquidity a lot easier for business generally in the UK. So a lot of the money and a lot of the pressure from government is not necessarily to drop the rates on mortgages for property investors like us, but it's to allow lenders to offer things like business interruption loans at a relatively attractive interest rate to help businesses trade through this very difficult period of time. I'd also suggest at this stage that a big drastic cut in interest rates like this means that at some point these will have to go up as the UK comes out of this crisis as well. So most investors maybe take advantage of this right now, especially on the purchase of any property. Generally, we would take a variable rate, something that's not locked in, but for the longer term, still look at your fixed rates for the longer term, because that way you know where you are. You've got a good idea of your profitability by having that fixed rate. You've taken out one of the biggest areas of uncertainty. Now, when interest rates might change again, when they might go up, whether the government will put pressure on the Bank of England for even more quantitative easing, what other measures they might do, we don't know at this stage. This is a situation right now. Interest rates can't really drop much further than this unless we go to the other way and we've got effectively a negative interest rate. So at this stage, it's really about keeping liquidity in the marketplace. Keep an eye on what's going on with fixed rates. And as I say, don't try and time the market or do anything particularly clever. If there's a short-term opportunity to take some advantage from this in your portfolio, by all means do that. But for the long term, it's still worth having the majority of your portfolio sitting on fixed rates so you know where you are, you can budget effectively overall.